Well, Silicon Valley Bank, a sad tale of woke and pandering and taking the eye off the ball. A lender to some of the biggest tech firms in the world, became the largest bank to fail since the 2008 financial crisis, the second largest bank collapse in the country, sending shockwaves throughout the tech industry and Wall Street. I guess Jim Cramer can't win them all. I'll get to that in just a second. Joining me now to break it all down is host of the Trish Regan Show on Apple Podcasts and editor-in-chief for TrishIntel.com. Trish Regan joins me now. Trish, good to have you. Trish, the reason why I said that take a little shot at Cramer, because I want to let's talk about this guy a little bit. You and I were at CNBC, I believe, at the same time that Jim Cramer was at CNBC for all those years. And, they love to tout Jim Cramer as some sort of stock guru. But the reality is, Trish, you can jump on board with this. The guy is horrendous at picking stocks. He's lost people. It's a running joke on Wall Street. You should do the opposite of what Jim Cramer recommends.
Yeah. Look, he's an entertainer, and he's quite entertaining. I mean, you got to give him that. I mean, the whole set and the whole shtick. I like him as a person. I never had any issue with him, Eric. But as far as is he on the money in terms of picking stocks? Listen, it's a hard thing to do. And it's the reason why people actually do specialize in it, and they make a ton of money when they get it right, and they lose a lot when they get it wrong. Cramer is a television entertainer. He knows a thing or two, but to take anything that he says and say, okay, well, I'm going to go invest in SVB because, he thinks it's the be all end all. Well, that would be a mistake. I think bottom line, everybody needs to do their own research. Do not listen to television presenters. Go out and do your own research and make sure you're comfortable with things before you go out and buy them.
Yeah, Jim Cramer is great advice. Let's take a look at, speaking of SVB, let's look at Jim Cramer just a couple of days ago. Watch.
I think the fears were not justified. It's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap.
Stock's so cheap.
Yeah.
Trish, 320. Hold on. Don't jump in just yet, because I got another one for you. I have one for you from, let's call it last year. Another bank that was seized over the weekend, Signature Bank, but Jim Cramer thought that was a good buy, too. Let's take a look.
Let's start with Signature Bank. This is a New York-based commercial bank, but it's got 36 private client offices sprinkled across the New York metro area, California, and North Carolina. The thing about Signature is that it's a business-oriented bank, and to the extent that they have a consumer business, it's focused on the wealthy, namely business owners and senior executives who do a lot of business, and you can make a lot of money.
You're making a lot of money. That stock on that day, it was 288. Two banks that were 320 and 288 that are now basically worthless.
Yeah. So a lot going on here. Again, do not listen to Jim Cramer for stock advice. Rule number one, or anybody on television for that matter, make sure you're really doing some due diligence. But what Jim failed to tell people was that the regulatory environment had changed significantly for these regional banks, which means they weren't subject to the same kinds of liquidity requirements, meaning they didn't have to have as much cash on hand in the event of a bank run. Of course, nobody thought there was going to be a bank run. But when you think about a company like SVB that's catering entirely, Eric, to the Silicon Valley crowd, and you look at what's happened to tech in the last year, I mean, anybody ought to be able to put two and two together, I guess, except Jim on this one, because you had to have known that client base was getting really hit by the economic challenges they had. And so they were taking money out. What happened? Oh, well, they didn't have enough money there at the bank to give them back. Now, others knew about this. In fact, I believe a JP Morgan analyst actually came out last fall and said, whoa, this company's balance sheet is kind of scary because they're so devoted to this one client base. They didn't have any diversity, right, amongst the sectors that they were serving. So I suspect Cramer's probably having a more challenging time in this environment finding stocks that are interesting and worthwhile because,
Trish,
hey, you can make 4% in the Treasury.
There's what caused the demise for Signature Bank and then SVB over the weekend is because the Treasury market got so strong. You have 4 or 5%. Treasuries looked like it was pushing 5%. Yeah. Meanwhile, the SVBs of the world didn't see that coming. They were borrowing and loaning at 0 to 0.5%, and so they were getting squeezed. But smart analysts, smart people who did their homework realized that there's going to be a squeeze on banking. Here's the other issue. Smaller banks like regional banks, as you aptly and astutely point out, they don't have a mark-to-market requirement that some of the bigger banks do, and so they can float losses until things get better for them, unless there's a run on the depositors, on the depositors, the customers. You and I say we want our money, and they go, oops, we don't have enough money for everyone, and then there's a rush for the door, and that's exactly what happened here. So the question is, do we now, and this is a little wonky, but very quickly, do we now require all banks to mark to market, which would save something
I think you have to. I mean, I think this illustrates the point. So now the Federal Reserve came out and said, we're going to open a window, and any bank that's having these liquidity issues, if you're worried that everybody's coming and trying to take out their money, well, guess what? We'll give you a loan on those treasuries you got. We'll give you a loan so you can get through this. I suspect what we've learned in all this is that, yeah, when you're a bank, you kind of have to put yourself through a certain set of stress tests, as they call them, right? So that you can handle things if a rainy day comes along. Otherwise, you'll have a two-tiered system, Eric, where the big guys, the JP Morgan Chase, the Wells Fargo, the Bank of America, they're the ones that are like, A-okay, and the rest of them no.
Exactly what we have. We have a two-tiered system, two-tiered banking system, and now it's being exposed right now. Trish Regan, always good having you there, folks.